So, hello, and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Here we go. No trade calls, recommendations, and response for their own stuff. We're here for educational purpose only. So, what's happening, guys? Good stuff, good stuff. Happy to see some usual suspects in there. Let's get this party started and see what happens. Now, again, nothing's off the any everything is on the table. You can ask anything you want. I really don't mind. We'll try and keep this to about an hour's time. I mean, we can run less or we can run more. It's no big deal, but just don't want to make it too long for the uploading afterwards. So again, if anybody has any questions, anything they want to look at, anything they want to discuss, questions on trading, management, sizing, office layout, screens, position you're managing, anything you want, just shoot and we'll try and cover it. Maybe what I can do for starters is basically also to give everybody a chance to join in and ask some questions and write questions out. I'll start by looking a little bit about where we are and doing a little rundown in terms of some of the major markets or what we would usually look at, and then we can take it from there. So in terms of location here, what's happening in terms of the ES, maybe to give you a little bit of a background of how we're looking at things right now. ES stuck around this 31.33. For those of you that follow on Twitter, we've been talking about the fact that we've been stuck in essentially what is a chop zone inside this 31.33 and 3,000 mark, right? And what we said is as long as we're stuck inside this range, it's really much to do about nothing. And we really need to see a substantial break outside, whether that's subsequent daily closes outside that range or a weekly close outside, to get some kind of traction. But it's still a tricky one because even if we break higher, we've got resistance further up, and if we break below, we've got support further down. So it's still a messy zone. Our base case assumption is that, broadly speaking, we wouldn't be surprised if we have already seen the highs and the lows for the year. Naturally, we wouldn't be surprised if we break higher or lower, but right now, unless something substantial happens, again, we expect this to see a lot of chop inside this range, or at least as we get into the election, and then we'll have to see what gives. So right here, in terms of ES, there's just not a lot going on. We're just really stuck inside this range. Okay. Now, another way of looking at how choppy this area is, if you want, a good way to look at it is you can look at, let's see, the SPX, right? And if you look at the SPX, look, it's even clearer. You see what I mean? So basically, you've got this island reversal pattern we discussed in the past. For those of you that are following on the blog and those of you following on Twitter, this island reversal pattern, which is holding, right? We gapped up into that zone, then we gapped down, and you see every single time we try to regain that gap down, the market slaps it back down. So this is showing you how important the zone is. And why we've been repeatedly saying, people saying, oh, your Twitter feed is boring. You're not saying, well, nothing's going on. This is what, we're stuck inside this range, and that's where the fight is on. And the best way to see, even though this market keeps on getting bid, it seems to have this eternal bid. Right now, it looks like there is an important line in the sand that has been drawn, and to me, it's very obvious here if you look at it on the SPX chart, which is essentially this island reversal, the market trying to defend any move. And as long as we don't take that out here, the way we've been looking at it is we've been either trying to buy dips, gap downs for a ramp up into that 10, 11 a.m. window as an intraday trade. But as a bigger trade, as multi-day trade, we've been looking to sell any kind of failure back in these highs, either for, a little bit of a scalp, but to see if you can catch a little bit of a lottery ticket for a move back down, even if it's going to stay inside this box, this choppy range. Does that make sense? So that's really the broader the broader view on the ES. Okay, now we usually don't look. I see some questions on the YM, so we can cover all the indices. The YM, very similar. We're kind of stuck. For us, the pivotal level here is 25,752, and essentially you can actually go back onto a weekly chart if you want, and you see that essentially, even though we've seen some wheeling and dealing, some people might be talking about some kind of huge megaphone pattern, but essentially right here, where are we? We are where we were back in 2018. So YM is really much to do about nothing. Of course, this is how Trump measures himself. That's why in the latest interview, he said he expects the market to be back at all-time highs by the end of the year. Of course, he's talking about the Dow, right? Not the other ones. But you see, the YM isn't doing anything. Now, of course, you have that permanent bid in the market, which is essentially all NASDAQ. Over 50% of the gains are all tech stocks. And the NASDAQ is staying cocaine angel, as paradoxically, even in this pandemic, it's been a safe haven play, right? Now, what we mentioned on Thursday, well, I got my days mixed up. Yesterday was Thursday. Yeah, yesterday I tweeted out, actually took a stab to the short side, is look at a NASDAQ once again. It's back extended. It's rallied 20% from that 200 DMA. And you see it's a similar, it's not usual, it's rare, right? And it's a similar kind of extension we've seen the same way we failed back in February, March for that move down. Now, it doesn't mean we get that move down, but here by all kinds of metrics, if you see, we're trading about 20% above from the 200 DMA, and here's pretty much virtually the same, right? Same kind of extension, and also we could see some kind of protection coming in ahead of this next roundish number, the 10,500, and this to me looked like an interesting level to try and take some tactical shorts. Also because we were looking for this ramp up. If you're a student of market action, of history, etc., seasonals, you'd expect the market to ramp up into quarter end, month end. They're going to save the positive month on the ES, etc. So it's only normal that the NQ stayed bid. Also, we're going into 4th of July weekend, and seasonally, right, market is very, very bullish. It ends very strong going into the 4th of July weekend. Coming out of it, you see a lot of volatility and a little bit more weakness, but it tends to be strong. So everything was pointing to this push. And what we'd been discussing is we were looking for some kind of ramp, almost like an OPEX ramp, to be able to sell into it. And here we got that move right into that level, and then you started to see some weakness, as you can see on the 1 hour chart here. He gave you very nice tight location. I mean, it might not work, but here essentially that's what's happened. And again, it's all Fangman, but what's interesting is also if you look at Fangman, right? So basically this is just custom looking at Facebook, Amazon, Netflix, Google, Apple, Microsoft all together. What you see yesterday was interesting because we had that ramp up and then bam, it failed. And it failed, right? And we got a nice reversal candle on the daily. So it's going to be very interesting to see how we behave. And if you look at, again, let's see if this works. Yeah, NDX, also very similar because, it's pretty much exactly the same kind of extension. Don't hold me to it because it's just, I don't know if I drew it perfectly, right? But same kind of extension here, about 20%, 20.5% off that 200. And then if you look at how the NDX closed, right, you saw this reversal candle, gap up and reversal candle. So it's interesting. We'll have to see, but that's where we are. And last but not least, what's going on in terms of the Russell? Most of these companies are hemorrhaging money. But again, the Russell is also stuck. It's weaker. We have an open short here. We like the Confluence around the 1450, a previous gap down zone for the puke. So 1, which is a big level if you go back in time. 2, that gap down. And number 3, it's the confluence of the 200-day moving average. If you're interested, you can go back on the blog or you can go back on the YouTube channel. There's a video where we talk about this level on on the Russell. But again, the Russell is really stuck. So it's been YM doing nothing, Russell staying weak, a Fangman pump, right, to be expected, and the ES is still stuck in those levels. So again, if you're trying to get too carried away with the news flow, you're going to go crazy, right? Just focus on the levels. You'll see if the market cares about any kind of news flow or whatever's happening, because price will reflect that. If price doesn't reflect it, it means the market doesn't care. So it's just much easier to simply look at where, what price is doing. Okay, so that's where we stand in terms of the equities, right? Yeah, if you're looking at the bonds, essentially, I mean, let's see, 10-year yield, right? So you see we've broken back down. We were very vocal about this press here towards the one where he said this is where you're looking to sell this, right? So to buy back bonds, right? Not to get excited. And here we had a nice move right back down, and it's actually broken down below this level. And you see how it's getting sold at the 50 here. So you see how it's trying to hold that breakdown. So here, this is a very important pivotal level. You've got to watch this, but unless this can regain the 1% mark, we still expect we're going back closer to zero, right? This is one, as long as something substantial doesn't change in terms of policy or in terms of whatever something big has to hit, there's very little reason to want to be short bonds, right? We had a nice breakout. We traded this, for those of you who don't like to trade the futures, through TLT2. Got a beautiful little rip here, and now it's stuck. But what we suspect is that any dip here is still going to continue to get bought for ultimately this to break higher. It's very hard to understand or to see how they're going to let with the current debt situation, etc., yields explode, right? This is just, any dip is going to get bought. A lot of people are hungry for yield, and all things being equal, it's still decent. I mean, this is more prone to an accident than gold, but still, it's very hard to see how you'd want to be positioned short on the bonds, right? And again, as I said, this is similar to the gold play, and gold is still bid, right? There's very little reason in this kind of situation to want to be short gold, unless you're looking at it tactically intraday. This looks like it still wants to break higher. And also, if you think about the fundamentals, there's just no reason to want to be short gold. Why would you want to be short gold, right? In terms of the bigger pattern, what's playing out here, you see it's come right back into this 50 back, and it's trying to go back into those highs. Our base case, and probably why you've seen people talk for those higher levels, is that on a break above these highs, right, assuming everything continues, central bank policy continue, we've been looking for a move towards that 2400, and an extension that's into the 3000, 2800. Now, clearly, if you want a gold with an added kicker, you'd probably look at silver. But again, it's a tricky one. I think gold will have a purer play, easier path than silver, but silver is a little bit like gold on steroids. And again, as we discussed the other day, our base case is still, especially after this fake out, was to see silver back into the 20s. It's just very, very hard to get long here. If anything, you want to get long the breakout or the retest for that move back into the 20s. And if everything rips back towards the 25, but it's really hard to get bullish, open new positions here. One thing is the tactical outlook. One thing is opening new positions, right? When you look at crude, let's look at the September contract. When you're looking here at crude, essentially, it's just trying to come back and fill that gap. And there's an extremely interesting action, right? An extremely interesting zone, which is this whole, number one, the gap fill zone. And two is the 200 DMA. So here, I wouldn't be surprised in the wheeling and dealing this trying to go higher, but we've been looking for opportunities to sell here. And could this be putting in some kind of head and shoulders? Right? Maybe. Could this be popping into this zone? Sure. But any kind of an aggressive failure here, I'd be partial to look for this to come right back down into, into the 30s, possibly if equities start to trade heavy back into the 20s. But really, I think here the play is understanding that you could get a little bit more strength here. But all in all, in this zone, I would be looking for weakness or opportunities to get back short to play for a move back into this level. Now, what is interesting also is, if you look at it, is that we're going into a period here. Let me see if I can highlight it. Top left, you're going into the back end of the year. So in terms of seasonals for crude, it's a more bearish time for crude. So that's also interesting to look at it in the context of that. So we'll have to see what happens, but clearly I see no reason. Also, if you look at the economic situation, geopolitical situation where we are, I'm really not going to be chasing crude here into the gap fill into the 200 DMA. If anything, I'm looking for opportunities to get short, right? Not to get long crude. And maybe before I tackle the questions, the last thing we can look at here is the DXY, right? The last piece of the puzzle, right? And you see, in terms of the DXY, we're still chopping around here, and to me this is very comparable to the ES, right? And that means unless something substantial happens, right, you should not be surprised if, globally speaking, right, these highs and these lows, broadly speaking, hold. Something substantial has to happen for us to break out of this range. But in any case, still, we'd be sellers of any aggressive rally, because essentially also the Fed has told you what they want to do, etc. So, there's no reason for us to be structurally long USD. Now, could it pop if equities come down a little bit? If there's a little bit of a panic, could it get a safe haven bid? Sure, but we would consider that to be temporary, and we would consider that as a shorting opportunity. Now, we were short very aggressively here, and what we said is, once we held this 200 week, we said here you have to get tactically long for a move into 98, possibly into the 100, where we would be looking to get back short for a move back down. So right here, we're still favoring longs on DXY, whether, irrespective of the fact that we have a bearish view longer term. So that's in line with our view and our trades on Euro, where we have been structurally bullish Euro, looking for this to move back into 116, 118, but shorter term tactically here we're short, right? So that's pretty much where we are. Basic markets, indices, bonds, metals, crude, and DXY. Okay, let's look at some questions. What level of retracement would be an interesting long on silver? Again, I'm not a fan. You have to be careful, especially if you're trading the futures, because it's a big boy contract. But it's a really tricky one to trade, because it's very volatile and you can get a lot of drive-by shootings, right? So here, what I would be tempted to say is I would like to see a move back into 1716. But at that point, you might not get that move. Do you see what I mean, Fred? So it depends how desperately you want to be short silver. We've been looking at it in the daily webinars as tactical buys in the 1750 range. There have been a lot of interesting tactical buys with tight stops. But if you're not trading it tactically with tight stops, if you're looking for a bigger retracement, you would look for it to come back into this cluster and take out all the weak longs up here. So maybe into the 16 level. But if you're trading more tactically, I think there's also an opportunity to either try and accumulate around that 1750 or again, wait for a possible break up, and either by the break up or by the retest of the break up, that would be, once it's already moving, that's probably be preferred play for me. I still, depends on your risk profile, but I still think you'll get even though short term, you'll get times when silver will outperform gold, right? I still think that structurally and in terms of a smoother ride and hold and less volatile hold, gold is still a much better one to have if you're looking at a fairly lazy buy and hold kind of view. Okay. Yeah. Is there a minimum RRR you look for before taking a trade? For instance, no matter how certain you feel about a trade, you won't take it unless the RRR is above 2 or 3. No, absolutely not. I think the risk reward is a fairly misunderstood concept, or a concept that a lot of people use without really understanding it, right? I've talked about this a lot in past interviews. You can go and catch it up. But basically what you'll see is a lot of less experienced traders will get very excited talking about risk reward, right? Oh, I take risk 1 to make 3. I only risk 1 to make 10, whatever, right? Or they get very excited talking about what their percentage win rate. Man, I win 90% of the trades. Hey, unless my system wins 70% of the time, it's a crap system, right? So you have to understand that usually, right, if in my opinion, let's keep this neutral. In my opinion, is looking at risk reward by itself, saying I risk 1 to make it, or looking at percentage win rate by itself is missing the bigger part of the picture. Okay? What you want to look at is you want to look at risk reward with the percentage win rate of the strategy that you're trading, right? Because you may get a situation where on a strategy you might have a 90% win rate and it's a 1-to-1 risk reward. On another strategy, you might only have a 20% win rate, but it's a 10-to-1 risk reward, right? So you might get a situation where very different percentage win or very different risk reward profile end up both being profitable strategies or not interesting. So I don't look at it as just risk reward. I look at it at what is that specific trade, what is the specific trade I'm taking, and what is my expected win rate based on my stats, my experience trading that kind of setup relative to the risk reward. Okay? And there's no right or wrong. You just have to understand what kind of trader you are. Some people, you could give them a strategy that has a 20% win rate, but such high risk reward that it's a guaranteed winner over time, and they still won't make money on it because that's just not the kind of strategy that fits their personality. They can't stick with it, or it just depends. Is that helpful? Okay. Hey, Mr. Deadlift, how's it going? Okay, cool. Yeah, here on so on the euro, what's going on the euro? So again, we're very, very light on the euro here, and the base case assumption is the following, right? Is that it could not attract new sellers at lows below that 108 level, no matter what the market or the headlines threw at it, okay? So just unable. Now, whether you have institutional or sovereign demand there, we don't know, you'll never know. So it's kind of like a pointless discussion. But what is interesting is that it was not able to attract new buyers at lows, on those new lows. So we've been, our base case assumption is, again, very aggressively buy here for a move back into the 200 DMA, okay? Now here we're kind of stuck in a very choppy area. Now what you'll see is every time we kind of pop into this 200 or whatever, you get everybody going, oh, euro 120, euro 120, euro 120, and then they get smacked. Every time we start to trade a little bit lower, you get all the die euro crowd that comes out. Euro's going to zero, euro's going to 80 cents, and inevitably they get smacked. Bottom line, the reality is that the euro has, like the dollar, has gone nowhere for an awfully long time. So you can probably make a very eloquent and good argument for both being structurally long or short the euro. And I mean, I really don't have a problem with that. What I can see is just abstract wise, just not thinking about the fundamentals at all. What I'm seeing here is that essentially we're stuck inside this range. We've been stuck here for a long time. We tried to break that, couldn't get any traction. And then we came back down. And this essentially, the shorts had everything in their hands to really smack this down and cause that pain. Even the time it tried to rally, there was a big smackdown. And there's no way it could get any traction. So inside here, don't get confused by velocity of move inside range. But if we start breaking below 104, then there's a very, very good chance that we'll aggressively try and hit parity. And if we break above the 116, there's a very good chance that we're going to try and go back to those, test those highs again. So right now, it's still inside of a choppy range, right? Now, if now you want to overlay where we are with the equities, the fact that we're going into the summer months, which tend to be a little bit more, a little bit trickier for the market, a little bit trickier for risk. The fact that it's stalling around this 200 DMA, the fact that we're coming in and we've got earnings coming soon, would it be absolutely crazy to see a picture also because euro tends to trade seasonally weaker July and August? Would it be absolutely crazy if this 200 DMA held to see euro come back down towards the 110 mark or towards the 50-day or to then try and make its move back in September after the summer, after they've agreed all this stuff? Absolutely not, right? So that's our base case here. A lot of chop, a little bit of strength here on the dollar, a lot of headlines coming in with the euro packages they have to do. They'll take it to the last minute. They'll kick the can down the road. They'll have some kind of overnight press conferences that finish at 4 or 5 in the morning. And ultimately, once maybe also a bit of pressures come through the summer with the earnings, and they'll decide some kind of package. And overall, the coronavirus, the response has, they're ahead of the rest of the world. They're coming out of it. They'll agree something, and bam, we get a little bit move up. Is that move in September going to be the move to 120? Who knows? But I also think that structurally, euro's better place to come out of this than the U.S. At least the way we're looking at things now, and that could also be in line with an interesting move, depending on what happens in the election, to be overweight euro stocks, so euro 50, and underweight US. That could be another way to express that view. But essentially here, structurally longer term, we're bullish for 118s, 120s, but shorter term, we'd be looking for this, like all the dollar pairs, to correct a little bit here, right? That's pretty much sums it up. I think here it's just I think it's already hard to forecast what price is going to do, when it's going to, etc. But on top of it, if you're also trying to add a specific timing to it, it's not my ideal way of playing it. Right? So I prefer to play levels rather than specific time frame also. And again, I think, and a lot of people have been discussing this, as everything pent up, the only way out of this is probably going to be with some kind of explosion of FX vol, right? So of course you'd want to be long FX vol, but I prefer to look at it a little bit simply and giving myself time. Trade management is where I lack most in my understanding. If you were to start trading all over again, what advice would you give yourself for the management of the learning curve or the trades? I think something, again, that's a very long and complicated question, but I think like most things in trading, a lot of people have problem with trade management for probably two big reasons, right? One is because they have no idea what they're looking for, right? You have to have a very clear idea when you get yourself in a trade, what you want to happen and where you're wrong and where you're right. And stick to that idea and manage that idea as per your initial assumptions. So a lot of people will get into a trade, but they'll just get into a trade because they read something. They have no idea where they're wrong or when they're right. Or they'll get on a trade which they've looked at or studied on a daily chart, and then they'll try and manage it or micromanage it on a 5-minute chart. Or they'll get into a trade on a 1-hour chart and then it starts to go against them. And because they don't want to take a stop, they start looking at the weekly chart. So you have to have a very clear idea of what you're trying to do, what you're trying to achieve, when you're right, where you're wrong, and manage that trade accordingly based on the time frame you entered the trade and you did the analysis. Number one. Number two, a lot of it is simply because people trade too big. So when you're too big, when you're over, you're too big relative to what would be your optimal size. You're never going to make the right decisions, and that's going to cloud your judgment and going to cloud your trade management. So again, off the top of my head, without thinking about it too much, I think those are the two big issues. So I would say, one, do your homework and stick to your homework, and number two, trade smaller. Here just keep in mind that everybody's dying to be right about the next big call, right? And kind of like what we discussed on the ES, I wouldn't be surprised if we see a lot of chop, especially at least into the election, right? And that's the thing. Don't be obsessed about calling the next bottom or calling the next top. Be happy to trade whatever price is doing. And I think for everybody, as a bit of trading advice, the moment you start to forget about wanting to be right with your bias or picking a top or picking a bottom and just coming in and reacting to what price is doing, the better you are. That's also why I prefer to take kind of like shorter term positions or just trade price, because it means that I don't have some kind of big bias, right? Unless I'm taking a position further out, Fred, and my just bet is pure bet on something on vol picking up or whatever, right? But I just want to be careful with with my bias overall. Okay. Alex in the house, rock and roll. What's my view on cable? Okay, sure. Well, we've been long Euro GPB and short GPB USD, so full disclosure. And basically here, what we're looking at is basically a lot of chop as Bojo and company struggle to deal with this situation, whether it's COVID and Brexit, right? Again, I'm not going to look at trying to get political or whatever. I don't want to fall into that at all. I think let's just keep it simple and just look at the and look at the levels. Okay, so what this is pointing to here is that we're still trading fairly heavy. It's trying to bottom after kind of the worst is being priced into the market, right? So here essentially it's very easy, is if COVID or Brexit or whatever ends up being worse than the market thought in its worst case situation, we're going to blow through those lows. If it's much better and it's all solved, then we have to take out the highs and rip. And if it's much to do about nothing, as we try to negotiate with the EU, well, then kind of like the ES, well, the high and the low, globally speaking, could be in. You start to see a pattern, right? There's just so much uncertainty out there that unless we get some kind of big change, there's no reason for price to violently trade outside of the ranges we've been put. And this is why I think a lot of people are struggling lately, because they desperately want movement. They desperately want the next big low or the next big high, where the reality is most charts, they're stuck in broader ranges. And if you understand that, and if you're willing and happy to trade the broader ranges, then you're doing fine. Wait for extremes. That's what we've been doing. Patiently waiting for extremes inside the broader ranges. And if it's not at extremes, not too interested, right? Not interested in NASDAQ, only trading tactically long, all those gap downs, because, every single time we've seen, a lot of people mention on Twitter, we've seen Friday they close heavy, Sunday they gap down, buy them, and they ramp back up to unchanged or plus 1%. It's just, it's always does that. So why would you want to sell them on Friday on the low? Well, anyways, you never want to sell the low or buy the high on a Friday, but why would you come into the week thinking it's going to, you're trading against the gods? If 9 times out of 10 market does something and you play 10 times out of 10 that play the wrong way, and you just get excited the one time you get it right, and every other 9 times you keep on thinking it's going to be that 10% move, 10% occurrence when it's not, you're going to have a horrible life, right? If you being, that's just the way it is, right? You have to do your homework. So here on cable, I'll be looking at the 124 as a pivotal level. Daily closes below, would expect it to try and test the 120-ish range. Daily closes above, it could easily come back into the 128. But structurally bearish until we can get daily closes above the 128, which essentially will be back above all this set of moving averages. But essentially here, would still expect this to trade sideways to heavy, okay? Would I be trailing? You mean if I trail my stops and stuff? It depends on the position. Again, I don't... if this is the first time here, you'll be disappointed with a lot of my answers, because people always answer something and they want a specific answer. And as I'm famous for saying, is the only real answer is always, it depends. What's your RR? What's your preferred? Depends. What's your favorite strategy? It depends on the market. Do you trail your stops? It depends what trade it is, right? What kind of leverage do you trade? It depends. Do you use fibs? It depends. Yeah, the only honest answer, I feel, intellectually honest answer and real answer is it depends. Unless, if you ask me, do you want to have sex with animals? I'll tell you no, right? That's a flat no. But if it's a trading related question, most time I'll just tell you it depends. And the problem is, what people do when they start trading is they latch on to somebody selling some kind of service or something that comes out and is very secure, right? Very convinced. So the people tend to be attracted by those personalities. People that are on Twitter say, Euro's going to die. Euro's going to do this. ES is going to do that, right? I don't know, right? And a lot of people say, why do you have 2 arrows? You're copying out. I don't have 2 arrows because I don't know. Price can go up, price can go down, or price can go sideways. But I sure know what I'm going to do if it's trying to go up, and I sure do know what it's going to do, what I'm going to do if it's going to try and go down, or if it's doing sideways, right? You have to have plans for scenarios and then adapt to those scenarios. If this happens, then that's going to happen, right? So would I trail my stop if I'm trying to scalp 5 points on the ES? Absolutely not. If I'm long euro structurally for that move higher and I'm trying to build a position and on one day there's a mega ECB announcement and it rips 300 pips, you bet your bottom dollar I'm not going to take any profit. I'm going to try and trail because something significantly changed and I want to try and hold this. So, right, it really depends. But my advice would be, for what it's worth, is anything that's too dogmatic or too black or white, it's not going to help you over time really with the trading. Trading's full of a lot of counterintuitive things, right? And if you try and make it, some things have to be black and white, but you have to be flexible. Have to be like water, right? How would I analyze volume to reconcile with technical analysis? Again, I think it really depends what you're trying to do. First of all, if you see anybody trying to look at volume on Spot FX or something like that, run as fast as you can, right? So it makes sense if you want to look on volume on some kind of regulated exchange, if you're looking at the futures, etc. And, people will use volume profile. So again, it depends how you want to analyze and what you want to do. I personally don't, it's not a major part of my work. I don't feel it gives me significant additional edge to what I already do. So I will look at volume here or there, but if you're a newer trader and you have a lot of issues to deal with, I would strongly recommend that you focus on naked charts, understanding what price is doing, and take it from there. Right? There's some basics that I think everybody needs to know to be a good trader, right? Or anyway, to have a good understanding of what price is doing, and a lot of that can be gained just by looking at a blank chart, understanding what price is doing, and understanding what price is doing in the context of the day, week, month of the year, right? Of the time of day, specific day, specific week, specific month of the year. Once you've got that down, then you can start adding things, and those are all little layers of granularity that you can add to help you. But if you don't understand the basics, you're always going to, if those foundations aren't strong, you're always going to have some important things missing. Mayafra in the house. Okay. Any other comments and questions? Don't hesitate, guys. Nothing's off the table. I would say that if you think that the market has to do something and it's not doing it, getting upset about that is the best way to lose money, right? The market will do what it has to do when it has to do it. So go with the flow, go with the market. Don't focus on trying to be intellectually right. And the worst thing of this whole move here is, it's kind of like that thing is, you see guys who are bearish, and then every time the market gaps down and rips, they're upset. They're upset at the Fed, they're upset at Bernanke, they're upset at Paris Hilton, whatever. But if that's what the market always does, why are you going to press it to the short side, right? It's the same thing, right? Don't get upset if it's always, if the market always gets bought at a specific point, well, don't keep on selling it and getting angry, right? Just try to study what's going on. You'd be surprised how many people spend years looking at charts and they don't really understand what's going on because they've only been looking at it through the lens of their bias. They don't look at what's actually happening. Alex, well, I always like your comments, but Alex is saying it's relaxing for him to hear an experienced trader say, "I don't know," but that's the whole point. Is that I often say this and people laugh, is nobody knows anything, right? It's nobody knows anything. There may be people that are better at reading price than others, etc. But essentially, it's always a coin flip. Nobody knows. That's why in my opinion, the only, especially if you're trying to trade intraday, etc., the only disposition you can have is, well, if this happens, then I think that's going to happen. But nobody knows. If you do your homework, you know that you may know that in specific setups or occasion or things, market tends to play out like this 50% of the time, 60%, 70%, but it's never 100% of the time. So nobody knows. You're just making educated guesses, and then you're trying to structure those educated guesses with your capital and interesting risk reward for that kind of idea. But nobody knows. Nobody knows anything. In fact, if you go on Twitter or if you read the analyst reports, etc., etc., usually, the smartest guys are the worst traders, or the smartest guys in the rooms don't actually trade for a living, because it's very hard and it's very counterintuitive. So, but again, Alex, nobody knows. Nobody knows. Do you agree that on a higher time frame there is really only one trade on the board? Long, short, equities, dollar. Let me see if you mean that there's only one trade on the board? It's all the same trade. Is that what you mean? Yeah. Well, yes. Yes and no. Globally speaking, you be careful with the normal assumption of correlations, right? Because correlations work and they don't work, right? Depending on where you are in the cycle, what's going on. So you can get smacked around a lot if you don't understand how correlations work. But essentially, it's all one big trade, right? Essentially, it's all one big trade. That's why... And I know I'm going to get flack for this, but you see people, and everybody's done this, right? When you're younger and you're thinking about constructing your 401k or some kind of ETF portfolio, the classical thing is you go, okay, 30% US equities, 10% European equities, 5% international equities, X% VNQ, X% dividend stocks, right? All that. But essentially, it's all the same freaking trade, right? And especially in the last 10 years, the way QE's been going, the way central banks are doing, it's very hard to outperform just being outright long SPY or the Qs, right? So especially the more we've been moving towards this new central bank reality, it's all the same trade. And even like trying to diversify a portfolio with 25,000 ETFs, I would think 99% of the people can outperform a simple timing model on the SPY, right? Whether you're looking at the 10-month moving average, you just be SPY 10-month moving average, long above, close below, you're all in cash or you're all in bonds or whatever. 99% of people don't outperform that. So yeah, it's just one trade really. Of course, on the shorter time frame, it's different, but I don't think I wouldn't put it on the daily. I would say longer term, there's only 99% of the time there's only one trade. But even on the daily, there are a lot of things that are moving differently. Does that make sense, Mark? Look at here. You could say equities, here are the Qs, right? And here's IWM. See what I mean? So really, in essence, it's all the same trade, but in practice, it's not. I don't know if that answers your question or not. Okay? Any comments, any questions, anything else anybody's looking at? Again, nothing's off the table. No, I don't trade single stock names. Very, very rare. Single stock names, the last single stock names I traded. Long was, we had a long on Facebook. Beautiful long on Facebook, which I got out way, way, way too early. So basically, I was buying Facebook very aggressively. I think my average break even was $17, right? Long, funny story, but for another day. But as I had my prime calling me up saying that I was nut job because it was going to get massacred when I was buying this. But basically, I'd accumulated fairly large position good on Facebook, and then, if I'm not mistaken, I was flat here, and basically I missed all this, right? So I missed all this. So it was a good trade, but I left half of it on the table. And then the other one was the famous or infamous, I was short Tesla on the whole 420 saga. And then also there I got out very early. I didn't catch this whole last part of the move. But again, there you go. The last, 10 years or whatever, two names I can remember. It's be more likely for me to trade an ETF, but single stock name, very, very rare. See any questions? We talked about it at the beginning of the session. Look back. I think you came in a little bit late. I think one thing you can do is I talk about a lot of these things there are a lot of interviews on the blog. I'll send the link to everybody in case you're interested. But I think my number one, if you think about general advice to traders, but I would say that, let me see if I could send the link to everybody. Let me know if it works. Okay, let me know if you got the link. I think the most interesting thing for everybody to start with, if you're having trouble or to improve your performance, is just to trade smaller. That's the number one, is just drop your size. Drop your size to whatever you think is small. Once you've found what you think is small, drop it another, thanks Alex, drop it another 50%. Trade's ridiculously small. And then make sure you understand the basics. Make sure you understand what you're doing. And remember that there's no holy grail. There's only hard work, right? Every day you need to come in and work on it. Work on understanding where we are, understanding context, understanding the levels, making sure your bias doesn't get into the way. But the first biggest step is really just trade smaller, right? Well, why do I prefer futures rather than single stock names? I mean, futures, well, first of all, you're essentially 24/7 or 24/5. So I can get in and out whenever I want, 24 hours a day, pretty much. And so again, in everything, what you want liquidity. And by definition, if you have liquidity, you want good commission structure, but then you want liquidity, and that means a tight bid-ask spread. So hard to beat the futures, right? Also, futures are a lot more capital efficient, right? To hold the same kind of notional exposure, you need a lot less money in your account. So you're tying up a lot less money. So that's also why futures make a lot more sense. And then in the futures, you're less susceptible to some kind of, I don't know, the CEO dating the mailman or the mailwoman, whatever, fraud, shenanigans. It's just it's just you can't beat that. But, primarily 24-hour liquidity and a lot more capital efficient. Any other comments? Any other questions? I think I got to most of them. Don't hesitate. Anything you want to ask, shoot. Yeah, we covered all the indices. You just got in. I'll post the recording as soon as it's available. We covered ES, YM, NQ, NDX, SPX, Russell, gold, silver, crude, DXY, euro, cable. Yeah, yen. Well, you're going to be surprised here. We're still another one where we're still kind of stuck, right? And so again, here, it's just not, you see the same kind of pattern you're seeing on ES, stuck, DXY, stuck, etc. So there's just not a lot going on. Our base case here has been, since all these failures at the 200, is we're looking for this to come back and retest the 104s. And it just looks like we've got unfinished business below here. We need to clear all these weak longs here. And if we can get some traction there, we might actually, and especially if that's in the context of stocks moving aggressively to the downside, we might try and take a stab lower. But I think here, to answer your question, all talk of BOJ intervention is very premature. I think the BOJ will be active and on the wires if we approach 100 verbally. If we break below the 100, then they'll start to get a move on. But right here, I think talk of real intervention on BOJ doesn't make any sense at all. But again, it's very choppy, right? It's just stuck. It's the same as the DXY. There's just not a lot going on. Unfortunately, that's the nature of where we're in. So I think the most interesting thing really, and I've been talking about it, even though we do expect FX vol to pick up later on in the year, I think here you really want to watch the equities, right? That's going to be that's the key thing to watch. And shorter term, going into the beginning of the week, what you want to watch very closely is the SPX. Is that island still defended? And if so, we would not be surprised to see this trying to come back into the 3,000 mark or into the 200 DMA, right? And the other thing is, again, watch NASDAQ, because as far as we're concerned, we have very nice and very interesting reversal at those highs at a very extended level, right? Okay, makes sense? Good stuff, guys. Okay, it was awesome to spend there you go, an hour with you guys today. Wishing everybody an awesome rest of the day, a great 4th of July weekend. I'll post a recording. Thank you for stopping by. All the best, and I hope to see you guys around somewhere soon. Take care. Bye-bye.